Trading often seems like a game of numbers, charts, and algorithms. While those elements are crucial, there's a hidden force that truly dictates success or failure: our psychology. The way we think, feel, and react has a profound impact on our trading decisions and ultimately our outcomes. Imagine a skilled archer aiming for a bullseye. Even with perfect technique, a wavering mind filled with doubt or fear can send the arrow off course. Similarly, a trader with a solid strategy can be led astray by unchecked emotions or faulty thinking patterns. This is where trading psychology comes into play. It's about understanding and managing our inner world, our emotions, biases, and thought processes to make rational, disciplined decisions in the face of uncertainty and risk. This essay delves into the fascinating interplay between psychology and trading, providing insights and techniques to master your mindset and elevate your performance.
Think of emotional discipline as the rudder of your trading ship, guiding you through the turbulent waters of the market. Without it, you're like a ship tossed about by waves, reacting impulsively to every gust of market movement. Emotional discipline doesn't mean suppressing your emotions entirely. Instead, it's about acknowledging them, understanding their influence, and preventing them from hijacking your decision-making process. For instance, consider the feeling of fear. It's natural to feel fear when a trade moves against you. However, letting fear dictate your actions might lead to selling at a loss prematurely. On the flip side, greed can tempt you to hold on to a winning trade for too long, hoping for an even bigger profit only to see your gains evaporate.
Even the most experienced sailors wouldn't embark on a journey without life jackets and a plan for navigating storms. Similarly, risk management is essential for staying afloat in the unpredictable sea of trading. It involves a set of principles and strategies to protect your capital from significant losses, ensuring your survival in the long run. One fundamental principle is defining your risk tolerance. How much are you willing to lose on a single trade or in a given period? This isn't a number to be guessed, but rather a carefully considered decision based on your financial situation, investment goals, and comfort level with risk. Once you know your risk tolerance, you can set appropriate stop-loss orders, which automatically exit trades at a predetermined price level, limiting potential losses. Another critical aspect of risk management is diversification. Don't put all your eggs in one basket. Instead, spread your capital across different asset classes, sectors, or markets to reduce the impact of a single trade going wrong.
Section 4. Trapped by thinking, unveiling common biases. Our minds are wired to make sense of the world around us, often relying on mental shortcuts or heuristics. While these shortcuts can be helpful in everyday life, they can lead to cognitive biases that distort our thinking and decision-making in trading. One such bias is confirmation bias, the tendency to seek out information that confirms our existing beliefs while ignoring evidence that contradicts them. For example, if you have a bullish outlook on a particular stock, you might be more likely to notice positive news articles or analyst upgrades while downplaying any negative information. Another common bias is the sunk cost fallacy, which leads us to hold on to losing trades or investments longer than we should, simply because we've already invested time, money, or emotional energy into them. The rational approach is to evaluate trades based on their current and future potential, not on past losses.
Section 5. Fear and greed, the two-headed monster of trading. Fear and greed are perhaps the two most powerful emotions that can sabotage a trader's success. They often act as a two-headed monster, driving irrational decisions and clouding judgment. Fear can paralyze us, preventing us from taking calculated risks or exiting losing trades when necessary. It can also manifest as the fear of missing out, or FOMO, leading to impulsive decisions based on the herd mentality, chasing after the latest hot stock or market trend without proper analysis. On the other hand, greed can make us overly confident and prone to taking on excessive risk in pursuit of quick profits. We might ignore warning signs, over-leverage our accounts, or hold on to winning trades for too long, hoping for an unrealistic price target.